It's not most of the thing, it's the whole thing. If your product doesn't have a good fit, it can be as innovative and as interesting as you like. If people don't want to buy it, if there's no pressing urge to get it, if there's no trajectory for you to get there, you're going to be in a world of hurt.
Today's episode is about 3 critical decision points and its implications on the startup journey around having co-founders, bootstrapping, and taking on venture funds. Our guest today is Duncan Weatherston, co-founder and CEO of Smile Digital Health, a leading health data storage and integration company. Smile's story is quite unusual, as the co-founders bootstrapped the business to roughly 10 million ARR to then raise a $20 million Series A as their first round. And at the same time, they bought out 2 co-founders with the round. Today, Smile has raised a total of 50 million to get to well over 50 million in annual value. With that, welcome, Duncan. It's wonderful to have you on. Your journey is not the typical venture-funded startup journey, which makes it a fascinating one. So for today's discussion, I'd love to chat through 3 critical decision points around bringing on co-founders, bootstrapping at the start, and then taking on venture funding down the road. And so let's start with the first one, the decision to start your business with co-founders versus going solo. Can you walk us through that decision at the time?
Thanks for having me on, Pascal. I'm looking forward to chatting about today. I think the decision to start with co-founders is probably the most essential starting point decision you're going to make in the process of building your business. I mean, obviously, the issues around what do I do and how do I do it are going to drive what the business is. But how are you going to succeed? How are you going to get to your end goal is going to be driven by your staffing model. And having co-founders generally is driving towards alleviating some of the staffing challenges you have at the beginning, right? If you think about the objective is to find someone who's able to have the same degree of interest in the business as you. The objective is to find somebody who's got a complementary set of skills that are going to drive value in the business. Somebody who's going to be able to pick up the slack when you need it, and you're going to be able to pick up their slack when they need it. You're building a long-term relationship with an individual or with individuals in a way that is aligned around the delivery of the services or the capabilities, whatever your business is going to be. I think the decision as to how you move forward is going to be critical in the short term and in the long term to the success of your business. In the short term, when you pick a partner, you have to consider things like, are they going to be able to contribute the direct value that we need for the service that we're delivering, right? So for example, in my case, my co-founders were sales, they were in software, they were in investment. We had a pretty rich team of co-founders who had experiences across the board. Enabled me to build software at prices that would have been, much higher had I not done it through a partner. Enabled me to have very rapid outreach and engagement with potential clients and others through my sales friends. And then over top of that, I was able to have an established business and, sort of have a regimen around what we were doing through my other co-founders who, came from a software and an investment background. And so for us, we had 5 of us who started the business together, and it enabled us to sort of cover all of our bases immediately. I think one of the things that's really important to consider when you're thinking about it, though, is the longevity of that partnership. Each of us had similar ideas, but 2 of our co-founders really were the ones who came from sort of the investor software background, had a very different idea around when to exit and when they wanted to exit versus James, Clem, and I, who sort of had a longer term vision. And it worked out for us. In my case, the partners who wanted to get out early got out early. The partners who wanted to stick around stuck around. But I think the lesson that was really important is that if we'd had the wrong people, and I've had lots of businesses where I had the wrong people prior to this, you don't get out of the gate well. You don't get off the ground rolling. It's very, very hard to achieve your goals because, for example, let's say you have a partner who's committed to finding funding and they can't find funding. Then all of a sudden your plan gets taken astray by lack of funds. Or let's say you had a partner whose goal is sales and is unable to sell your product regardless of the quality of thing you've built. Well, let's say your partner is in software and are unable to write the vision that you've sort of had together. Each of those scenarios has showed up in previous businesses of mine. This is the first business I had where all of the necessary alignment came together with the partnership, and it's panned out. So I think, like I was saying, the most essential thing you can do is find the right partners if you're going down the partnership model. An alternative, of course, is the not partner. And, we have our investor, Sunny Singh, chose that path when he started his business, and he's been incredibly successful. And I know a few others I've worked with as well, who've all done incredible jobs of taking the risk themselves financially. But the challenge there is that then you have to have sufficient funding, and you have to have a sufficiently early business model so you can drive the revenue to cover the costs fairly quickly. And everybody I know who's gone down that pathway has found themselves faced with challenges in that space. And so I think the decision to start your own business in terms of doing it solo has to be driven by your sort of thoughts around how quickly you can drive revenue, how much support you have in terms of funding, how much investment you're able to raise for the efforts. And in those cases, I think the last piece I'll say on that is, and we'll talk about raises later on, if you're raising, you are essentially getting a partner who is going to be your funding partner, right? It sort of fills that portion of the model I said earlier on. When you think about who you're going to raise with, you really have to think of them as a partner, because they're going to be with you for the duration, right? They're going to be people who you're going to turn to for funds later on. They're going to be turn to for advice. So you're really sort of preempting the partner model by raising funds at early stage by sort of buying into a prepackaged partnership set.
I think one of the things that stands out is trying to find the right partners as you get started. Now, that is incredibly hard to know who the right partners are as you get started, because you don't know what the future is going to look like. How do you go, and already said so, you learned that lesson the hard way. What has worked for you in terms of evaluating whether someone's the right partner at the start when you don't know what the future is going to look like, versus what are some of the mistakes that you've made in terms of picking the wrong people with the wrong motivations potentially for what you were trying to build?
I'd say the mistakes, I'll start with the mistakes because it's easier to enumerate the things you did wrong than the things you did right. The mistakes I've made in the past are insufficient validation ones, right? So basically, it's very easy to find someone who says they can do something. So you get into it with them and then discover they can't do the thing they said they can do. That is like the number one challenge. Your humans are good at assessing who they trust and who they like, and who they think they can spend some time with. What they're much less good at is verifying the capabilities of people they like and trust. So when you meet someone who you like and trust, it's very easy to then get alongside them and say, yeah, well, let's go do this thing. We've got all the motivation, and you can build the intent, but you can discover very, very rapidly. And this has been the case, like I said previously, for software, for sales, for funding, for everything, that although people can talk a good game, they can't deliver. So what I did this time around was I picked people I knew from work experience could do the task that I was assigning them. And the reason why I'd had a challenge previously was I didn't go outside my comfort zone. I stayed in the architecture, software development, capability side of the world, and I didn't venture into the business side. So what I'd done previously was I'd said, okay, this person seems to know how to business. I'll partner with them. They can business and I'll do software. This time around, because my expertise is in software, I said, great, I can assess people who are good at building software. My co-founder is a rock star on every level, right? James Agnew, the person who founded Happyfire, is an amazing developer, a fantastic software leader, like a sort of guy you could always depend on when I was working with him. And so then when we started a business together, it was relatively easy for me to know he was going to be able to deliver on the areas that I was counting on him on. And the same thing was true for my sales partner. I'd worked with him in the past, I'd seen his work, and I was able to assess his ability to go out and meet people and sort of create introductions. And so that worked out very well. We did take a bit of a chance on our business partners on the software side, but given the character of what we were building, it was a safe bet. And so we were able to sort of work with them. They provided really good fiscal advice, and in terms of our early startup, gave a lot of put a lot in terms of our structure and our thinking around that. And then for myself, what I said was this time go outside my comfort zone and be the business person, right? And I think in that sense, that's the decision I was talking about earlier on in terms of our partnership, right? The thing you have to be able to trust in that success myself, right? I was the wild card here. I was the one going outside my comfort zone. I was the one going into a space where I had yet to prove myself, and they relied on me. And so I think that was the sort of critical path decision for myself. I think it's one that everybody should make when they're trying to start a new business.
Another thing that he told me that stuck with me was the characteristics that make someone a good partner at the start may not be the ones that actually make them successful as you grow your business. What do you mean by that, and how do you assess that early on?
I mean, obviously, if you think about the character of a growing business, right? And when you're 5 people, the need you have is collaboration. You need to rely on each other because you're doing the work yourselves. As you grow, you end up, if you're successful, with subsequently 30 people, then 100 people, then a few hundred people, and you keep growing beyond that. Um, the characteristics that should make you a self-motivated developer are not necessarily the ones that make you a motivational leader. The ones that make you a self-motivated founder aren't necessarily the ones that make you a great administrator. The ones that make, and you can sort of enumerate all the challenges. And so when you're starting your business, the thing you have to realize is you're going to have to work with your partners and find the best fit for their skills as you expand, should you be successful. And what that means is if you stick to a simple regimen that says you have this title in this role, and as you grow, you retain that title and that role in the same way, in the same light, you're going to come across eventually areas where you lack experience, unless you happen to be fortunate enough that all of you have grown businesses from 0 to 1,000 before. You're going to be in a position where you discover areas of lack of experience or inconsistency or whatever it happens to be. And you're going to have to have a pattern to work around that. And this is where making sure you have the right partners really, really pays off, because the right partnership can model itself around that, right? So in our case, what happened was the 2 business guys who said, we aren't in a lifestyle business, we're in a, build and sell kind of model. They sold their shares to somebody who's become, in my mind, one of our core founders. He's been fantastic. He's the chairman of our board and an amazing guy. And then the existing partners, Clem and James, have both sort of positioned themselves effectively. Clem is now, from being my sales guy, he's positioned himself now as international development, and he's out there sort of proselytizing to the world about Smile. And then James has focused on being the CTO and sort of overseeing the technology. We have a lot of operations people underneath them doing delivery. And so I think what we found was that because we had the flexibility to reimagine our roles inside the company, we were able to move forward. I've been in positions in the past where that flexibility didn't exist, where people thought of themselves in very constrained or controlling positions. And again, same problem. As you grow, you're not able to adjust to that. And I, in one of my first successful businesses, we ran into that problem, right? We were unable to sort of reposition ourselves effectively. And ultimately at the end, it led to, a lack of success in that business.
It's a small thing, but one of the things we always advise the startups that we work with is to be very cautious around what titles you give out early on, because it's impossible to reverse them. And if you take away a title from someone, ego gets involved. And that's typically when people leave, not because they're not good at what they do anymore, but because in their eyes, they're getting demoted, even if they're not, because a title gets stripped away.
100%.
Another thing that stuck out to me is what you said is, as important as it is to find the right partners and everything early on, you have to be very mercenary if someone's not a fit. What do you mean by that?
It's the toughest thing, right? Because so you start out, this doesn't, I guess it could apply to partners, but partners have a stake in the business that makes it a bit harder to be mercenary. It applies more, in my mind, to the staffing that you get at the start. Part of the opportunity, it's what you said about titles, and that for me is a really critical thing. It's a lesson I learned the hard way. If you call people directors or senior directors or vice presidents as a sort of mechanism to retain some degree of seniority when you're a small company. Picture you're starting a small company, you've got a bunch of people coming on board who you've known for a while, or who maybe you've worked with in the past, or who are coming from similar roles elsewhere, and you entice them into your company. They will come with an expectation that there is some upside to them in terms of maybe being promoted, or maybe having a bigger fish in a smaller pond kind of approach, right? And so you give them titles like vice president or director, but then you grow into a business that actually is, needs a vice president or a director. And suddenly somebody who is good at managing 3 people is completely the wrong fit. I've got departments that have 120 people, 150 people in them, and a person who can manage 5, and then you grow very rapidly. You grow over 4 or 5 years. Suddenly somebody who's managing 4 people as a small growing business is expected to do something in an administrative role that is completely unsuited to them. And by giving them a title, they're now they're bound to that role and they're not able to step away. But exactly as you said, because it's hard to take a demotion in title, and so we made that mistake early on. We had all kinds of people with titles that were effective for the size of the company when we were smaller, but were ineffective as we grew, and we had to. And we weren't mercenary, right? So one of the challenges that I made, one of my mistakes was I didn't, as we grow, say, you know what, this isn't working out. You're not good enough to be a director of a department of this size, or your inexperience is showing, and we're going to have to sort of retrain you, or you're going to have to leave. What I did was I tried to work around it. I tried to find ways to, bring other people in. I think, if you think about the Peter Principle book, it talks about people getting promoted to their level of incompetence and then getting parallel sort of promotions to move them out of the way. And you end up trying to do that. And it's bad for you. It's bad for your staff. It's bad for everybody. And it is very easy to fall into that model because these are people you care about, that you like, and you wouldn't want to bring any harm to. They worked with you since you were small, right? You feel a great deal of debt and engagement with them, and it becomes very difficult to move on. The net effect is it's bad for everybody. When I say do you have to be mercenary about it, you just have to recognize that despite your feelings and despite your sense of fairness, you're not actually living up to fairness. The rest of your team aren't being treated fairly by having a superior who's not competent for the role. That individual isn't being treated fairly by being expected to do things they just haven't got the experience for. The entire relationship becomes fraught because now you're not getting the outcomes you want. It's just bad for everybody if you are not blunt and straightforward. So when I said you have to be mercenary about it, what I mean is you just have to accept the reality. And the smarter thing to do, of course, is not to make that mistake in the first place, not to give people the wrong titles, not to give people the wrong expectations. But that's going to be very hard for you as a startup, because part of bringing the people on is going to be that incentive that they can do more. And you're going to have people who step up and you're going to have people who don't. And so that's the challenge you're going to have to face. So I would say upfront, just be prepared for it. I don't think you could avoid it completely. But you can go in eyes wide open and have those conversations up front.
Especially some of the most driven and best people are very focused on getting bigger titles and stepping into the shoes. With those, it's not as much of a problem, but there are a lot of others that won't then fill those shoes, and basically weeding out. But it's almost impossible, as you said, to kind of figure out early on who's going to be able to kind of evolve as the company evolves versus who's going to get stuck at some point.
Yeah, it's especially true in a software business. Let me just one more point on this. In a software business or a technology business, you can have technologists who are spectacular, right? Who come on board and who are talented above and beyond the means of your own company. And so the temptation is to give them a title, but in fact, they may be very happy just being a technologist, right? One of the things I like, some companies come up with promotion pathways which are not staff driven, which are essentially parallel promotion pathways for technology. I think you have to really consider how that dynamic works for you, because you definitely can't undermine the value of a senior software developer, but giving them senior management duties may be bad for you. So finding some mechanism to manage that tension is also really important in our type of business.
The last topic I want to touch upon before we go into the decision to bootstrap versus taking on external capital is, when we work with founding teams at the very start, we advise them to actually ideally do 5 or 6 year vesting schedules for the founders, because one of the most challenging things that can happen for a startup is that you have a lot of debt weight debt equity on the cap table, where founders leave after 3 or 4 years and they own 10 to 15% of the company. Now you have 5 co-founders out there. I understand there's a lot of trust involved as well. How did you early on figure out kind of that challenge between trusting each other as partners and kind of the potential challenges down the road of too much of the company being owned by people that weren't going to work with the company anymore, partially because they wanted to get out earlier?
So I think the reason we were good was we all had a 5-year horizon in mind when we started the company. So when we started, we all agreed we were going to reevaluate after 5 years, and our expectation was we were going to sell after 5 years, and then move on to other things. What happened in our case was around 4 years, we recognized that we had already exceeded our wildest dreams at 5 years, and made a reevaluation as to who was going to stay and who wanted to move on. And I think that was pretty clear from our dynamic. I would say that if we had stuck around in in the sort of structure we had, we would have had to find a way to incent investors later on to participate effectively, right? I think it would have taken a broader collaboration and what have you. But in our case, like I said, we started out with the expectation that we were going to invest within 5 years, and it was a transition to not do it that way. I think your advice is very wise, and I'd encourage everybody. In fact, seeing where we got to, I would strongly advise people to have a vesting strategy for the participants, so that at every level of your growth, you know what the expectations are for the next 5 years.
So maybe moving on right to the second topic, bootstrapping versus taking on venture funding. Why did you decide not to kind of try to take on external capital as you got started?
We had a number of reasons. The most obvious one was that we had enough capability in the founders to build the things we wanted, and we built a good enough company size to deliver the value we thought we could, just by having the participants, right? So, in the early stages of this, I had myself and James Agnew. We were both sort of technology people with a history in that space, and we were working in the field that we wanted to work in. So we were able to leverage our experience to build the solutions that we would want to buy for ourselves. So it gave us traction in terms of the product we were building. It wasn't a invest and see what happens. It was more of a visceral thing where, we need these things, we're doing these things, this is working for us. And so by getting fully engaged in the community we were in, it was helpful. My sales part guy, sort of businessy sales guy, I asked to become a partner, was doing a great job, and so we had a good footprint. And he and subsequently the two people he introduced us to, who came on board, were all sort of VC sort of background people. My co-founder, two of the five of us had VC backgrounds, and so we were able to assess collectively whether we thought we needed it or not, and we decided that we were in a position at the start that, given the technology we had, given the low cost of our salaries, which was zero, we weren't paying ourselves anything at the start, the need to raise capital was low. We bootstrapped about $50K, and paid that back right from the start. We were okay, and then because it was clear that we were being successful, we didn't need additional revenue to cover our costs. It never occurred to us to really go after any money until we had a better sort of product opportunity. And really what we were thinking with us thinking we're going to sell at the end of 5 years, our expectation was that at that point in time, we would find some venture firm or some capital firm that was, interested in taking it to the next level and work with them to move it on. Right. So our expectation wasn't that we weren't ever going to get funding. It was just that the right time for us for getting funding was as our product was more mature and underway rather than at the start. And I think if I were to look at any business I ever started, I always started my business as bootstrapped. I've always, put only my risk in. I think maybe that goes to through my character as well. I don't want to risk other people's stuff when I'm not sure. I'd rather give people a more concrete offering. And so, if I go to someone and say, "Hey, give me some money, I'm going to do a thing," it means that I have to be more sure of myself than I do if I just going to try and do something on my own. And I go, with other friends or partners to try and get that stuff done. It's been easier for me in terms of the emotional load associated with it.
Knowing what you know now about both kind of working with funding and without it, would you start the company again if you had a choice without funding, or would you actually take on funding for benefits that come with having more budget to invest into the business?
It's a tough question. I mean, to be fair, I've gone through a lot of conversations with investors, like hundreds, and I have found that in the areas that I'm trying to express my interest, it's been very difficult to convey the value prop. I mean, we've grown from scratch to a $50 million US a year business, and we've got a very big growth plan for next year again. And every year people say, we don't really understand your business. When I talk to them, we don't think there's any value. Well, not that we don't think there's any value, but we don't see how you're going to grow. We don't see this is going to scale, whatever, right? There's always some reason why they don't understand our business model. They don't, and so, I would say that I've had a very hard time, clearly, of convincing the investment community of this value. The people who've invested have been people who are, and we'll talk about that in a second, but the people who've invested in our business have been people in the business who understand the value prop of what we're doing and get it and are able to see where we're trying to get to and what we're trying to get to. And it's been on the back of more or less visionary individual investors that we've been able to achieve what we've achieved, because they were able to see beyond kind of some of the abstraction of middleware, right? And get the value prop we're talking about. And I think, you know, I'm determined to make sure that they get rewarded for the efforts that they put in, right? I want them all to be more successful than they anticipated. But that goes back to what you were asking about when you're starting, right? You have to be able, like, you know, if you think about the challenge of making your vision wait for you to be able to convince somebody else your vision's worthwhile, that's a big risk, right? You know, especially in a place where you're trying to get to market quickly, you know. So I think, like I said, if I were doing it again, I probably would try briefly to see if somebody was interested, because it would certainly been a lot easier on us if we'd had, say, a couple of million in startup funding, because then I wouldn't have had to be quite so dependent on the services model to grow the business, right? You know, basically when I grew the business, as I wrote the software, which would be our product, I was able to do it with participation from our clients who understood that we were a small business growing. And so they were paying us to add capability to the product as part of the delivery of value for them. And so I think, you know, it put us in a position where we were less able to have a comprehensive product vision and more driven by client need, which, you know, one could argue is potentially a better pathway anyway. But like I said, I would probably, if I could make an easy go of it, raise a couple of million. But if it was going to take me more effort and more time, I'd rather invest that in building the product and demonstrating the value than trying to convince somebody else that I can do that eventually.
Yeah, that makes a lot of sense. Which is also a great segue right to your third big decision, which was kind of after 4 years, you know, gone past what you thought you would achieve in 5 years, and you had the choice to either pursue an exit at a certain valuation, or to kind of double down on what you were doing and actually go out and raise funding, which then led to you raising 20 million at the time, while also buying out 2 of the partners. Can you walk us through your kind of thinking and decision process that you went through at that point in time?
At the time that we were making a decision as to whether we were going to go for investment or whether we were just going to sell the business to someone, the motivating factor was our understanding of the need for our product in healthcare. You know, so we started off with this idea we could build a thing that would solve a particular market niche, and as we were going along, we really became more committed to the bigger vision of what we're trying to accomplish. So because we come from healthcare and because we've got a vision which is around better global health, transforming healthcare everywhere, as we started to see our product be successful, the compelling nature of that vision became more important for James and Clem and I. And we wanted to pursue it because we thought we could be impactful, right? At the end of the day, right, I guess it comes down to the decision: do we continue on or not? Is how much impact can we have, and how much value can we bring, and how much of transformation can we lead? And you know, it's all those sort of higher order accomplishments that make you feel better as a human being. That really sort of drove our motivation, right? I mean, in terms of financial success, we could have sold for a higher dollar than we'd anticipated when we started it. We'd have had a cushion and we could have gone on to other things. But the value prop for us was that there was an opportunity to be able to deliver healthcare value in many countries rather than just a couple. The ability to inform the way people think about using information in the delivery of care. The ability to inform the way people think about access to their own information for their own self-care. And all of those characteristics which are sort of essential to the well-being of your family, your friends, your community. Those are all things which drove our decision to stick around. I could imagine if we were doing another business where we felt that it was going to be less impactful, you know, where the motivation was driven more by fiscal realities, it may have been tempting for us just to sell because we were going to do better than we thought we were going to do. Why not try again after you've got a successful exit? It's certainly easier to convince everybody else that you're doing something meaningful after you show that you've already done one exit, right? So I think for us, the decision to stick around was that. And then having made that decision to stick around, it was a very clear decision that said, well, if we're going to go for it, we have to go for it, right? So, and I think there's a number of people out there that have very informative perspectives on this. There's Crossing the Chasm. There's Birthing of Giants that talks about their vision for this. There's a few of these organizations which are able to help you sort of think about how do you go for it. And I think given my good luck, I had an advisor who became the chairman of our board, who came on through my CFO and bought out two of my co-founders. And really inserted himself into our business as a founder. He's been lockstep with us every step of the way and has really driven our way forward. And he came from a very serious investment background. He worked with a big $7 billion fund from his day job and was happy to advise us. And so that really informed our pathway for the raise. And so we did the $20 million round at a much higher valuation we could ever have imagined. So, at the time, when we were thinking about where we were at 4 years, where we were at 5 years was, 5 times the value that we thought we were going to be.
Which is
which was fantastic. And it was great advice. And so we were able to raise 20 million without overly diluting ourselves. And that was like a really big deal for us. With that, we were able to grow again, and one of the things that was challenging is we were walking into a market that was being well funded and we didn't even know about it, right? We'd come in with kind of a bit of a neophyte kind of worldview, which is if we build a good product, we're going to be able to sell things. And in the US, there was this big shift towards our product's capabilities that was being funded by CMS. And there were people out there who knew that CMS was going to be funding it, who were building products to fill that market spot. But because we'd come from the right angle and from the right sort of motivation, we won a ton of business with those tailwinds. And so now we found ourselves in a position where we were growing very, very rapidly, where we had deliver 15 giant projects all on the same day. And we had a small amount of staff. And so we were working, all of us, 20-hour days, and it was chaos. And so with that sort of big pressure, getting $20 million to increase your staff, build out your support, increase your sales, build out your operations was transformational. It took us from being an overworked small business to a well sort of established medium-ish business with a global footprint. And it enabled us to sort of enter the world stage in a position that's had us now in Gartner's documents on par with Microsoft and Google in our space, right? So the funding at the right time and the right place in our business trajectory was essential, and the support of the investor as well. So this is where the main investor was somebody who had a similar business to us. And he had gone through a lot of our trials and tribulations. And he was, as I said earlier on, he had done it entirely on his own, right? He didn't have partners. He'd paid for it himself. So I got all of his advice on how he had operated, what he'd done to try and be successful. And it turned out that was really essential as we ran into some hard times, because he'd gone through those pains as well. And I think that was kind of the most important thing in our investor in our first round, was the quality of the person who did the investment. I think, so back to your question about how do I think about that decision to invest, this is another one, like I said earlier, about partners and assessing your partnership. The person who's going to invest with you is going to play a major role in the development, in insight, in advice, in mentorship, all the things that are going to be valuable to you, even if they're not taking a controlling interest. So there's somebody's actually validated your efforts, right? Somebody shows up and says, "I'm going to put my cold hard cash on the line," where previously you'd sort of put your sweat equity and your thoughts and your aspirations into it. This is somebody's taking a very different risk and can give you some of that mercenary perspective we talked about earlier on, right? They can say, "Look, I know how close you are to this. Look at where I am. Take a look at my vision. And if you respect it, and if you listen to them, you learn from them." And that's how I felt about our investor. I took a lot from him. I learned a lot from him, and he provided me with a lot of insight and value. And that was why we were able to continue to grow the way we grew. And we took that to heart, and we moved forward in the subsequent years with that. I will say we had unfortunate timing for a raise. We raised at the end of 2021, and 2022 the world changed, and so the character of what we were expecting to be our trajectory through the investment pathway was upended 12 months later, and we had to recover. And so we've been, there's a book, The Hard Thing About Hard Things. It is definitely worth a read, because it gives you a feeling for what it's going to be like running a business as you go through it. That's another one that meant a lot to me. At a time when I was going through a lot of trauma, I read about Horowitz's trauma in his business and his exposure to it, and it gave me a lot of heart for how do I move forward and how do I tackle my problems. I really recommend this is something which I'm independent of the things we talked about. I really recommend that business owners read good books by other business owners and other leaders. It gives you a lot of inspiration, a lot of things to hang your experiences on, and it's been meaningful for me. So the things that have been meaningful for me in this investment trajectory: great advice from investors, great advice from the community, great advice from the authors. All these things are part of the milieu that you're getting when you buy into that next phase of your business, and I think it's critical that you engage with that as part of your investment activity.
That's fascinating. I think a couple interesting things to unpack here. Let me first a quick side note. That's another book that I just read that I found highly impactful is The Upside of Stress, which is a good one to read if you haven't read it yet. But I think one of the things that also stuck out to me, kind of, and you partially talked about this already. You told me that when you took on venture funding, took on minimal dilution, but being a bootstrap company up until that point, I think what changed the most with venture funding outside cash in the bank was that you also took on a moral obligation. What do you mean by that part?
I don't want to tell anybody. I don't want to proselytize anybody. But if you're going to take somebody else's money, or you're going to take somebody else's belief, faith in you, you end up with a moral obligation to somebody else that is very different from that of people coming on the journey with you, because the people coming on the journey with you share the accountability for your efforts, right? They're participating, they're helping, they're in the thick of it with you. Somebody who's giving you money to accomplish your goals or to help you accomplish your goals is taking a much different risk, right? They've already earned this cash, and the cash has meaningful or material value outside of your business. You can do a number of things with it. And so once you take it on, you're taking on, in my opinion, a transaction of faith. You're saying, I will accept your investment in return for my best efforts to live up to the expectations I'm going to set with you, right? And those expectations you're setting are that you're going to return more value than they put in for their funds. You're going to ensure that you don't misuse their funds, that their funds are moving the business in the direction which you claim. That there's a whole set of obligations you take on to somebody else who's trusting you with their hard-earned dollars. And it is, at least from my experience, a different perspective than the collaborative work that you're doing with people who are trying to build a thing together, because in those circumstances, the transactions are much more, they're microtransactions, right? I'll do this if you do that. I'm going to try and get here. You're going to try and get there. You get to control, and it's a collective effort. As you go through the original bootstrap phases, you're just as beholden to your partners, but you're more directly coupled. They're just as beholden to you. The character of an investment is not quite the same. The person who gave their trust to you is nowhere near as beholden to you as you are to them. I mean, they've taken a risk on you and they've trusted you. You've just taken their money. There's very little you're doing that has that reciprocal trust. So you have to live up to their expectations and their hopes, in my mind. I've taken it to heart, right? I genuinely believe that my investors have put faith and trust in me that I have to repay twice as much as I would have to repay somebody who was just coming on the journey with me.
It's very fair, and I feel very similar about the people, or even though we're an intermediary as a venture fund, I feel very similar about the people that gave us money to own our own venture fund as part of that. Another thing to unpack a little more is, or you said you raised your first round in 2021, and kind of the world was in a different place and shortly after. And part of what came with raising around at the peak in 21, so that you were told to start spending the money a lot more aggressively. What were some of the mistakes that you kind of made on the back of that, and how do you correct those afterwards?
The mistake that I would characterize as being the most significant is the business model that came with spend aggressively, right? The pattern was definitely one that was functional 2015, 2016, 2017, where, there was a strong appetite for the coming years, and the risk risk framework people were willing to take was, we'll put a lot of money because dollars were cheap, right? In 2017, 2018, money was at 0% interest. So the relative risk was fairly low for people. So they were willing to have a more freewheeling kind of approach to the use of those funds, right? And so the mistake was thinking that was going to continue indefinitely and buying into it. And unfortunately, we came in at the peak of that. And what that meant was I had in my mind a risk tolerance of a couple of $1 million a month in cost, right? So we raised 20 million. I was thinking we were going to raise 75 million on the next round. And we were burning, in the tune of $1.5 million a month, right? So call it 15 million a year, 16 million a year by the time we were done. I was thinking of raising 75 million. So I had in my head a 4-year runway at that. And I had the growth trajectory, which was clearly going to make those numbers inconsequential as well, as we went forward. So I had baked into my thinking that a certain degree of loss was okay. When that realization didn't pan out, right? When I didn't end up with 75 million in my next round of investment, suddenly $1.5 million a month to $2 million a month is a material loss, right? Like on a $30 million raise, $2 million a month is going to burn through your money very, very quickly in under 2 years. And so suddenly you've got pressure to undo all of your growth trajectory that you'd been set up for, right? So, you had a thing where you said, I'm going to spend this much on this area of my business, spend this much on this area of my business. I'm going to take this kind of risk. And then you find yourself in a position where that's no longer supportable. You have to remodel your business to go back to the sort of way you were before. You have to, and the part again, which is very hard, the mistake, the subsequent mistake on that is not abandoning everything that you thought you were going to do immediately, right? Because if I had said upon realization of that challenge, whoa, we're going to go right back to bootstrapped and we're going to be profitable within the next 3 months, we would never have been in a situation where subsequent to that we were trying to scale back and scale back. We would have just been on a growth curve again, right from that point in a different perspective, right? So I think but it would have been very hard on everybody because all the promises you made, all of the ideas you had, everything you had was based on this one. And this is the biggest mistake is not adapting your ideas fast enough, right? All the ideas I had were based on the idea that if we put effort into it, we'll generate 100 million, 200 million, 300 million in revenue. Not realizing that I didn't have the backing to get there. And still trying to do that pathway or half do it or whatever, sort of try and only prune that which you have to prune and remain with the same sort of optimistic view is probably the biggest mistake I made. I would say that if I were to do it again, I would adapt to the new reality faster. I would model my business with that new reality in play. And I think I would have taken a bigger hit up front, but I would have had a longer runway as a consequence. I don't think we've suffered from it. I think, we grew, we are what we are now. We have this very successful $50 million a year business because we kept pushing on it. We ended up with 100% growth. But the net effect was we were really pinching pennies towards the pinching penny part happened differently than would have happened otherwise, because in one circumstance, pinching pennies is a managed exercise. If I cut everything up front and still had a pile of cash in the bank, then I'm managing against that load at a future facing rate. Whereas by keeping the burn on for growth and everything else, I got the growth, but then towards the tail end where I'm still burning some money, I had to very rapidly change my pattern and accommodate the reality of no additional funds, right? And so I think, hindsight's 2020, but I might have taken that pain a bit earlier rather than later. And it probably would have been better for everybody. All things said, though, but we're in a great position where we've got all the things going in the right direction for us, specifically because we didn't back off too soon. So, like I said, it's a tough call. It's easy to second guess yourself and be an armchair quarterback to your own history based on the way things work out. I have to say, maybe next year I'll look back on this and say, man, I was a genius because look how well we've done now. So
that's hard too. You never know. I think though one of the things that we see a lot across the board of companies. One of the things that I do think is true pretty much across the board is I hear it a lot that entrepreneurs, especially early on, want to raise a larger round, and then say we won't touch all the money and want to be very thoughtful with how we spend it. However, the reality is, whatever you raise, you are going to spend it. Because all of a sudden, you don't just have three like high priority items that you're going to spend money towards, but the fourth, fifth, and sixth, all of a sudden sounds attractive as well. So you're investing more money, and so whatever money you raise, kind of our notion is like, unless the revenues keeping up with it very fast, you're going to blow through it in roughly 2 years, because that's kind of how you're primed in the venture markets. And then you're going to get back out to market. And the challenge with raising more is it comes with a higher valuation, and it will just be even harder to grow into the last valuation. So you keep increasing the risk of the business, partially because you kind of overstepped it with regard to where you have to get to next.
That's very familiar for us as well. Yeah, and like I said, I think it's played out well for us. We're in a good position right now, and I'm very grateful for the journey we've had. But again, like your question was, what mistakes did you make? So it's easy to beat yourself up on the things in retrospect, right?
No, 100%. So maybe, right, because we talked through this whole journey, knowing what you know now, if you went back and kind of, I don't know, if there's one thing you'd do differently if you were to do it all over again, kind of same company, same journey, what's something that you'll probably do differently, having learned it the hard way over the last few years?
Yeah. So the number one thing I would have done is spend more attention in the later early growth, like, around 3 years and 4 years, to org structure. Right. When you're small, everybody comes on. We told everybody pick your own title. We had a very fun website where people had things like, Time Ninja as their title and whatever. Right. So it was great. Our clients loved it. We loved it. But when we grew, the lack of clear alignment of title and structure and role became a hindrance, and we didn't do a great job of rectifying that. And that's the things I talked about, right? Not having people who were in roles that they were too junior for, having misaligned implementation. I've got a fantastic team in operations now. I hired some professional management to resolve some of these challenges. I've got a fantastic president, George Rollins, who has put his heart and soul into helping us think through our structure. And so where we are now is a fixed version of where we were. If I were to go back, I wouldn't make somebody have to fix it. They could walk into a well-built system with all the roles in the right place and all of the thought about the significance add role to those things. I would say that is absolutely, I mean, all the other things aside, all beating myself about spending and those other bits and pieces, I think all of that would have been mitigated by having experts in the spaces where they needed to be, and having a thoughtful strategy around the management of those teams from the start. I think that would be the biggest thing that changed. And again, that's on me, right? So my own lack of experience in that space. So if I say one thing, the one thing I would say about a business is, if you're building it, you're the one who's got the biggest stake. Everybody else is helping you accomplish your goals. And so with that goes your accountability, right? I mean, you can say, well, that person didn't do this or this person didn't do that. They're marching to your drumbeat. You were the one who didn't do it. So I think that the thing which I would say is really important for everybody who's running a business is to recognize, and so on the what would I not change, I would double down on recognizing that the victories are your team's and the dramas are yours. And because you want more victories, you have to encourage that, and you want less drama, you have to manage that within yourself. You can't operate in this environment in a way in which you absolve yourself of the accountability for the thing you're building. You owe it to your teammates, you owe it to your investors, you owe it to everybody. And I think that piece is one which I can't emphasize enough, and I don't think we had a problem with that. I think our executive team are all very self-aware and very accountable people, and I think that's been the virtue that's got us through some of the harder times.
3 more quick questions that I'd love to ask before we wrap up. First one, what popular advice that is often given to startup founders or operators do you actually disagree with, and why?
So I would say the advice to change your MO to align with a particular approved approach. Like, think about what was happening where people, like when I got my first round, my investor didn't say this, but other people who were in the investment community were saying to me, don't be a noob, and put all your money in the bank and continue operating as a startup, right? That's exactly how you fail. You should go out and spend the money. That's what we're giving it to you for. Take the risk, etc. Right? And so you buy into that popular notion at the time, and then you discover that was really great for last year, not great for next year. Like the thing that the piece of advice that you should take to heart is the one that says, run your business as you know best. Right. I think founders and the people who build businesses have a worldview that is unique to themselves. For each business, they've got a goal and an objective and outcome they're trying to get to. And I would say the idea of popular advice is the thing that I would push back against for them. I'd say popular advice is great. It's something you take into consideration, but don't second guess your own capability and knowledge. Right? You can course correct. You can look at where you're succeeding and failing. You can be true to yourself. But I would say the most important thing is, as a founder, be true to yourself first. And that's not popular advice. At least maybe it is becoming that now. I guess I saw something the other day talking about founder model. But I think historically, you were told founders are noobs in general. Don't make the mistakes of being a noob. Founders aren't noobs. Founders are people who've got a clear vision. They've got a clear goal. They've got a business they're trying to achieve. The idea that somehow you're inadequate to the task and that you just need better coaching is a terrible flaw. And I think all the founders who are listening to this need to understand that they have it in themselves to do the right thing, and they're going to do what's right for themselves. Take advice and learn from it, but don't suborn yourself to it.
I couldn't agree with this more. The founders that I work with, I always tell them, whatever I tell you, I take this, it's one person's opinion that has so much less context on your business than you do. And so hear me out and do with it what you want, because ultimately it's your business and your decision, and you know best what to do from here.
What other piece of advice, which I got, which comes from a founder who I view as transformational, it's product market fit and the ability to determine your product market fit. I think that's one area where you can talk to other founders and you can talk to teams about and stuff like that. But the idea of what product market fit is so important to your ability to succeed that you can't underestimate that effort. And when you read about it in common literature, they just sort of blow by it and say product market fit is good. It's everything. It's not most of the thing. It's the whole thing. If your product doesn't have a good fit, it can be as great. It can be as innovative and as interesting as you like. If people don't want to buy it, if there's no pressing urge to get it, if there's no trajectory for you to get there, you're going to be in a world of hurt. And it's very easy to think you've found product market fit when you haven't. Right? It's very easy to think that a small alignment with a subset or a niche is a product market fit. It is an indication that you might get there eventually. So I would say the piece of advice I got in the counterpoint to your question, which was, which piece of advice would you view as being unnecessary? The one piece I would say is the most important piece of advice you're going to get. If you take nothing away from this, which is not even my own advice, it's other people's advice, get your product market fit day one, get your product market fit day two. Day three, when you think that you've got product market, rethink about it again and make sure you've got it again. Come up with a strategy which allows you to exploit it, and then build your repeatable business on the back of finding the right unit. I read somebody wrote the other day very wisely. When I finally found the repeatable unit, that's when I got investment and went double down on that growth cycle. When you get product market fit, you'll be able to identify what a unit of effort looks like and what the sale outcome is for it. And then you can be able to move forward. I wish I had understood that better at the start. I would be in a completely different place.
Yeah, no, that is very fair. And then with that, you actually also answered my second question. So let's jump on to the last one, which is, as an investor myself, I'm always curious to learn from what other investors did. So what's been the most impactful or thoughtful thing an investor has done for you or any business you've been involved with to date?
Geez, there's so many good things my investors have done for me.
If you had to pull out just one.
So I would say, well, it's tough because I've got two very good ones, but the number one thing that was really after the fact, I realized the wisdom of it was something that Sonny said to me. He said, "Who do you want on your team?" And I had a team, like, I want this and this, and we got that. He's like, no, Duncan, who do you want on your team? And it took me so long to realize what he was talking about. And the thing that he was saying is not what roles do you want, but who are the people? Have you met the people who are going to be the deliverers of the value that you want? Right. And I would say it goes back to the thing I said right at the start, but I didn't recognize that advice properly, is as a CEO, as a founder of a business that's growing, your team is everything. The people who are implementing and building your vision, the people who are realizing your goals, the people who are taking the company to that next level, the scalable realization of your vision is dependent on people who are as motivated, as dynamically capable, as clever, as internally incented as you need them to be, right? As the ones that are going to be your go-to. And if you've got people who are good enough or nice enough or strong enough, you have the wrong model. You have to be in a position where, like, think about the obvious icons that we can say, right? Johnny Ives or whatever, like the people who everybody recognizes in their own right as geniuses and accomplishing, and incredibly capable individuals. Those are the people you want on your team, and it's hard to get them. And so you can't start off saying, "I've got them." You have to spend your journey finding them and getting them and nurturing them and bringing them on board and getting the things you want. And that piece of advice from Sonny was absolutely critical. And it's one of which I'm still on the journey of, right? Because we have openings now that I haven't filled yet because I'm trying to find the ideal person for us, right? And I think that's the piece I've internalized the most, and that for me is the most significant advice because it's the one that I'm still trying to act on today.
Well, that's and couldn't be more true. That's it. Thank you again for joining me. This is super insightful. So appreciate your time, Duncan.
Thank you for taking the time. And I thank everybody who's listening. Thank you for listening. I really appreciate the chance to speak.